Property tax calculations. Property taxes are one of those things that either stop you from wanting to get a house or get you kicked out of the house. It changes every single year. Sometimes it goes down, but majority of the time it goes up. And there's a couple of calculations that come up for them to come up with the number. You have the fair market value. That's the estimated price of the property that it would sell for. And they usually get this fair market value by the area, what the square footage, what the house beside it sold for, how close is it to the city. Houses that are in the city of an area usually cost more than ones that are in the rural area for its taxes. Then you have the assessment ratio. Now that is determined by the assessor. He is just given a number, so to speak. And they usually do assessment around 40% to the market value to determine that taxable portion. For your state, of course, go to yourstate.gov, whereas for Georgia, people go to georgia.gov. So the formula for this is the market value minus the assessment ratio, and that's where they get the assessed value from. Now, for property taxes, what they do is they're going to subtract the exemption. Say, for instance, you have a homestead. I'm not sure if that is something you have in other states, but Georgia has a homestead. So homestead veterans and seniors get subtraction from their assessed value. Then after that, they use a mill rate, and a mill rate is $1 of tax per every $1,000 of the assessed value. Then the assessed value minus the exemption times the mill rate gives you your tax bill. Don't worry, I'll put it in the description down below. But that's how they get these taxes. Government decides what it's worth, and then we pay the cost. Now, in our defense, when you learn to do these calculations, there will be another form that you can put aside. Again, like I always tell you, a refund is not free money. You can take that refund and put it up to deduct what your new payment will be. And when I say new payment, say for instance, your house, say you're paying $1,294 now. Okay, your taxes came in around $2,500 or $3,000, but this year they're expecting your taxes to be about $43,000, which means that's going to put on maybe an extra $250 to $300. So your new bill would be $1,500 a month. Now, there are ways around that, of course. Now, if you have your refund money put up, you can pay the additive in advance. So say for instance, it's an extra $3,000 needed to put up for your taxes. If you are able to put that extra money up and just send it directly to the mortgage company, then your payment won't change. But if you're not, which most of us are not able to pay those lump sums up front, then our bill keeps going up. But again, you could take that refund check, put it in a dividend stock or any kind of performance stock for a year, depending on how your taxes are done. And here for Georgia, it's usually around October, but it's still a year. Well, that's not a year because you usually get your taxes around March. It's still a nice amount of time. That's 7 months. That's 7 months. You can either put that up to put that towards it so your monthly payment doesn't go up, or you can just add that into your monthly payment every month until it goes down. Either way, make sure you are thinking of how to get ahead. Oh, this is too long. Okay, until next time, later.